Okay, so in this video I'll be doing tutorial 8. This is the last tutorial for part 3 as there's only 2. Okay, so in measuring firm's profit, economic profit differs from accounting profit. So basically they're asking what's the difference between the two. Now, accounting profit is the normal type profit that we do in life, but economic profit, economists take into account depreciation, or not depreciation, it's called opportunity cost, yes. So the difference between economic profit and accounting profit is economic profit, to calculate it, you say revenue minus the total cost. Now the total cost is implicit cost and explicit cost. However, the accounting profit, you say revenue, which is the sales, minus only the explicit cost. So your explicit costs are like your rent, your products, okay? Implicit costs are opportunity costs. So for economic profit, you include the implicit cost, which is your opportunity cost. But for accounting profit, you don't. Now to complete this table, let's see it now. Okay, so what is this layout is, okay? So basically this is like a workplace, the number of workers. These are the products they produce. So like example, 0 people who work will produce 0 products. Marginal product is the difference between when you add another laborer to work. And average product is the total product divided by the labor. So to do this, it's simple. Obviously we put 0 over here. Now the next one will be 6, because 0 plus 6 is 6. Then to work out what's this one over here, we can use this, because the average product is equal to the product divided by this. So this will be 14, because if you think about it, 14, which is the total product, divided by 2 is 7. And then now the marginal product over here, you work out what? 14 minus 6. That is 8, isn't it? Yes, that is 8. And it makes sense, right? By adding one more labor, you got 8 more products. Because first you had 6 products with 1, now with 2 you had 14. Then 14 plus 4, that's 18, that's perfect. Again over here you have to use the same logic. Something over 4 is equals to 5. So that's 20. So 20. And then 18 plus something must equal to 20, so that's 2. Or you can see there's a difference of 2 over here and put that over there. Then the last one, you can see there's a difference of 1, so you put 1. Okay, this will be 0. Right. Now work at average product is the total product divided by the labor. 6 divided by 1 is 6. 18 divided by 3, that's 5. No, actually it's 6. 5, okay, they gave you that. This one over here. So the average product, so that's 21 divided by 5. So 21 divided by 5, when you work that out, that is 4.2. So it's 4.2. Okay, so we done that, right? 4.2. Now, what you must realize, or just analyze it, is the marginal product increases, then it decreases. And to analyze it even further, what this means, it means as you're increasing more laborers towards the end, you're actually not making more products. In fact, you're actually decreasing the products made. So this is actually very interesting. We'll look at it just now in the question. Then the average product also decreasing. It goes up, then it goes down. So the more laborers you add, it doesn't mean the more products you will make in a business, right? It'll come to a point where you add a certain type of laborers and now it'll go down. So did you notice that the marginal product or labor average product first increases then decline? So when the quantity of labor increases, explain why this is a common feature of the real world production. So explain why this happens. The products, as you add to the laborers, as you add laborers, it increases, the products then decrease. You see, after you add 3 laborers, it declines. Why? Because in real life, there's going to be problems, right? I want you to picture a business. If you have 2 laborers, you might be good, but imagine putting 20 in a business. There might be conflict. They might not all work equally. There might be too little machines, so they all are fighting for the machine. So at the end of the day, adding more laborers or workers might not mean more products made. No. So that's the answer for this. So now we're on multiple choice. Now, economic profit. I told you in the first question. Economic profit is your total revenue minus the implicit and explicit cost, right? Implicit costs are all costs that are opportunity costs. Explicit costs are all costs such as your normal costs, your rent, your inventory, you buy a chair, you buy anything. A trainee accountant decides to work in Deloitte, okay? Decides to give up her job over there, so she doesn't work there anymore, where she earns 100,000 a year. Then she was offered another job for 120,000 rand. So what is the opportunity cost of her working as a home? So basically she gave up these two, right? And she's working at a home. So what's an opportunity cost? It's the best alternative foregone. Some people will add this and this and say that's the opportunity cost. But that's wrong. Because for the definition, what's the best foregone? The best. Out of these two things you've foregone, what is the best? It'll be only this 120,000, right? So the answer will be 120. It won't be that thing added up. Because you're looking, what's the best alternative foregone? These are your two alternatives. Find the best one. That's foregone. Which of the following are parts of the firm's opportunity cost? Now, don't get confused about economic profit and accounting profit, how you work that out. And this, they're just giving a general. What's an opportunity cost of a firm? Opportunity cost of a firm, it's when firm gives up something. So think about it. Economic depreciation. A firm has a choice whether to, now depreciation, if you do not know, it's when you have like an asset, so like a machine. As time goes on, it'll lose its value. So yes, this is an opportunity cost because a business can decide to sell that product or that machine and not have depreciation as an expense. They can sell it, right? If there's a depreciation and causing an expense, just sell it. But no, they chose a choice to keep it. So this one we know it's right. Money, no. Soon as they say money spent, if money is already spent in the previous years to renovate the business, it's like you just leave it alone, right? Money spent, you leave it alone. Then implicit costs. Implicit costs, definitely. Implicit costs are opportunity costs actually. So that's like it. And then now when I was doing these questions now, I was like, okay, this is the answer, 1 and 3i. But when I wanted to find it, there is no 1 and 3i. So then I thought about it and it makes sense, right? Wages will also be included in opportunity cost. Why? To the firm, they have expenses, right? They can choose whether to pay the wages or to put their money in something else to pay. For example, let's say they paid wages of 10,000. They could have paid the 10,000 for another expense, but they chose wages. So technically it's an opportunity cost. So the answer will be, it'll be E. 1, 3 and IV, 1, 3 and IV. Perfect. Money spent as not an opportunity cost. That's already happened. All these are not, these are just general. You see general. They didn't say money spent on wages. No, they just said wages. In economics, which of the following to be regarded as always being fixed? Keyword, always. In a short run. So in a short run, you either have one factor of production fixed, right? You'll have one factor of production fixed, at least one. So when I say at least one, it means one and many, right? So you know one factor of production is correct. Physical capital is correct. Technology is correct. All these are factors of production. Now labor. So there's a rule that states when in short run, you can actually change labor. Okay, because it doesn't make sense to keep labor constant or to fix labor. You can't say, oh, I'm going to have 10 workers for 1 year. You can't, right? Maybe sometime you have to fire workers, you have to add more workers. So this changes. So what is always being fixed? Physical capital. For example, you might only have 100,000 in the bank to use in your business. Technology, you might only have 10 computers in a business. One factor of production, that is true. So labor is a no. So looking at the answers, It's 1, 2 and IV. So it's 1, 2 and IV. Now we do not have this over here. Oh no, wait. Oh wait, this is wrong because I told you at least one factor of production. So here they're saying no, only one factor of production must be fixed. So this is wrong. So it's only those two. Yeah, it makes sense because I told you at least one factor of production, not only one factor of production. So it's 1 and 2i. So 1, 2i, 1, 2i. Okay. Now the next one, what is the average product labor when 2 workers are employed? What is the average product labor when 2? So when 2 workers are employed, the output number of products is 14. The number of workers is 2. So 14 divided by 2 is 7 bags. The next one, diminishing marginal returns, set in which workers added to the production process. So when do the products that you make goes down? So in this case, we have to actually make a separate column here, marginal product. So I told you here it will be 0. Output is 6, so it will be 6. Then 6 and 14, what's the difference? The difference is 8. Then over here the difference is 9. So 8, 9. Then difference is 7. So straight away, by adding the 4th worker, I'm getting a diminishing marginal product. You see? 0, 6, 8 is increasing. Then 9. Wait, is it 9? 6. Yeah, correct. And then now it's not increasing. It's going down, right? 7. And you'll realize it's even going more down. So it's 4, yeah. And then over here will be 2. So when you add the 4th worker, it goes down. So when you add the 4th worker, okay. 7. Which of the following explain diminishing marginal product of labor? Workers are discouraged. Only workers are trained. All of the above, huh? All of the above, right? When you add too much of workers, these are the problems you face. All of the above, just problems. Refer to the above diagram. Which of the following is correct? Having a look at it, I think it's B. Because think about it. When 2 workers are employed. So when 2 workers are employed, you're looking at this point over here. The average product and marginal product equal. So let's work at average product over here. Average product is the total number of products made, which is 10 divided by the labor is, which is 5, right? 10 divided by 2 is 5. Now, how do you calculate marginal product? It's basically the difference in products from the previous laborer. So at 1 laborer, you had 5 products. At 2 laborers, you now have 10 products. So if you're going to work out the difference, like the increase in the product is 5, right? When you added 1 more worker, you got 5 more products. So the marginal product here will be 5. You see? Because at 1 worker, you had 5 products. 2 workers, you had 10. So by adding 1 more worker, how many products you made extra? 5, right? So 5 is equals to 5. So obviously B is going to be correct. And that's it for this tutorial and all tutorials for part 3.